weekend all. Ira Epstein, and we're here on Saturday, and this is the 16th of July, 2022. Interesting week. We are now about, 10 days or so away from the FOMC two-day meeting. The market could get reactions because we've had so much bad news that is actually a little positive in the market. Why? It is not uncommon that instead of pushing right into the Fed meeting, the market might want to take a bit of a reprieve. I can understand that. We've seen energy prices fall back. We've seen commodities in general slack to the downside. So there's talk of two things. Number one, has inflation by itself peaked out, or has it certainly abated? I think abated is without any question something that has taken place. The question is whether it's permanently peaked out or not. I don't know. If you listen to firms like Goldman Sachs, they're telling you no, energy prices are going back up to the 140, 150 area. This is just a lull before the market comes back. I don't know, but that is their point of view. If that's the case, that means inflation is going to rear its head and the Fed will get more aggressive to fight that when that occurs. If they're not correct and the market stays between, let's say, here and drops another $10, $15 a barrel into the $90 range and $80 range in the Brent, and carries with it proportionately the WTI, well, that's a little different story. Maybe the Fed doesn't have to get as aggressive come September and other rate cuts. Nobody knows. I mean, you can read all you want and people will give you their opinions, but nobody knows, including the Fed. They're going to be reactionary. Here's the thing to keep in the back of your mind. The Fed has the headwind, not the back. For a decade, more than a decade, all we said is the Fed has the market's back. That is over. The Fed is the headwind. And just when you think the market's rallying and it bottoms in, you'll discover the Fed steps back into the market, and that's how bear markets work. And they put pressure back on the market because they have one goal now. They've already beaten unemployment. In other words, they got a 3.6% rate. They don't have to worry about that in the unemployment. Therefore, they have to do their other mandate, which is inflation. They can't get away from that. That's the only two mandates they have. They do not have a mandate to look at the stock market and make it stable. They don't have a mandate to make the economy as a whole stable. They have two mandates. That's it. Inflation and employment. You watch those and you see where these markets might and might not carry. So now as we take a look at some of the other parts of the market, as I'm looking at how the market is dropping down, I want to go to JP Morgan because the big banks are what you got to look at. And I thought the numbers on them, on Citi, were not terrible at all. I know the market beat them up because they didn't make the numbers. But why didn't they make the numbers? Because they're putting away reserves at an increased rate, which is what the Fed is mandating that they do, for the recessionary impact of bad loans. That doesn't mean the bad loans are going to happen in the way that they're putting them away. You do realize that just about a month ago, the Fed had a stress test. They saw in the stress test the banks were in good shape, so what did they do? They let them give back dividends, buybacks. They did all that. Well, suddenly 30 days later, now we're back into they've got to tighten up. That's just how it works. And as it works that way, you're putting pressure back on these markets. Are they in a downtrend? Well, JP Morgan has been in a downtrend since it peaked out here, January 14th, and it has been working its way down. You had a respite. Here you got to 133.51. You came back in the market to 132.39, sort of stalled even, and you've gone down. But literally, each reaction high has been what? A lower high than the one prior to it. That's a classic bear. You just had a bearish crossover this week where the 18-week average of closes in red got itself up and under the 200-week. You see that. As that occurred, and that was back here, you then went and made a lower low. If you rally hard, look for big time resistance, 124.22 to 125.20. That's if you rally hard. I'm not convinced it's going to be able to do that. But what I am convinced of is you got yourself down within 3 cents of the Bollinger Band and you got a heck of a bounce out of the market this week. Bollinger Bands tend to be an area that the markets pay attention to. A resistance area in the market, strong, is going to be this 124.22 to 125.20 area, should the market be able to get there. And in momentum, here's the thing I'm worried about. If you've taken my enhanced Bollinger Band course, once you get, and look on the left, the bottom left, SSTO, once you get 3 weeks in a row where you're keeping the slow stochastics, which you've done, under the 20 level, you get a bounce, a sizable one often, if you get the slow stochastic, which is at 1979, to finish up in over 21. If it does that, I can make an argument to get back up here. If it doesn't, then I'm looking for an argument to fall back to the lower Bollinger Band. It's really that simple. In KBE, as I said to you last week, in fact, the past week since we got right here, which was the week of May 13th, the combination of the Bollinger Band, bottom right through here, and the 200-day average, formidable. Can we get a bounce? Absolutely. So we're starting to see a pattern where maybe, I want to use the word maybe, you get bounces, but in all the circumstances I'm seeing, those bounces are going to prove to be, I think, selling opportunities if they show up, and I'm not saying they have to show up. Here, if we take a look at the slow stochastic reading, it was embedded, and all of a sudden you lost it by closing at 2060 to a degree. I like it to be over 21. The fact that the market closed at the top quadrant of the day, even though it was lower on the week, doesn't matter. The way the math works, unless you drop sharply right off the bat, come Monday morning, you'll try to re-embed. But this is a weekly chart, so you have to go to the end of the week to know if it's going to be back over 21 or not. This is the gray zone in that market. When I come over to XLI, did we embed here yet? Well, you can see not there, not there. Week 1, 2. And what numbers are you holding? The combination of the Bollinger Band and the 200-day average. So chart upon chart upon chart so far is showing us that we have dropped enough into support that we're at a pause area of sorts in the marketplace. Now, pause area is not bullish. Doesn't mean you can't resume to the down. And so far, each of the potential rallies look to me like selling zones. In XLE, the energy, this is where I would tell traders they got to be covering shorts. Why? You're not embedded. First challenge of the weekly Bollinger Band, and that's the zone that you normally come out of the market, and you wait if it's going to embed or not. You haven't embedded. SPY has been in a bear phase since back here. This was the peak of the market on April 1st. And you finished at 452.92. You got as low as 362.17, and you've bounced a little bit. Okay. You're not embedded. You're just in a market that's drifting to the sideways, but you're about to get another bearish piece of information in that the 18-week average of closes is about to cross under the 100. Should happen as we reopen this week. That's just how the math is going to work, and that's because you're replacing the settlement of this week with one of the 18 back over here. That's going to drop the number down. In GLD, I teach not to go short under Bollinger Bands. I am bearish gold. Why would you want to own gold? Interest rates are strong. The dollar's strong. Other currencies down. Now, gold in its own, as I'm in Montana, I had a conversation with an investor here, and I was trying to explain to them that if you own gold in, say, euros, you've actually done well. As your euro has fallen in value because the gold is priced in dollars, even though it's down. It's making up the currency difference for you. So you always got to think of how do you own gold. But in dollar terms, it is bearish. You can do better with owning interest rates. You get something now, you 3% on some of these rates that you can get. If you go to corporates, it's even larger than that. Why own the gold market? It's not proving to be an inflation hedge. And I know I'm going to hear you write me and tell me nonsense. That's going to be the word I tell you. It was a war hedge. It rallied up on the Ukraine invasion. That's what it rallied on. And after that, the market couldn't hold up with the inflation. Charts are charts. They tell the story, not what you and I think. In the gold miners, if gold's no good, what are the miners? Well, there is no good too. And you're just riding this Bollinger Band down, still bearish. Can bounces happen? Of course they can happen. Is that going to change the trend? Not on the chart at this point. Then we get to ARK, and down here, when we got to the Bollinger Band, I told you I thought this could be where ARK finally has made enough of a break to be it. It was then, with it, lost the embedded reading, right through here. Since then, I've been looking for the market since right here, the week of May 27th, Can it get back to the 18-week average of closes at 49.68? It's certainly trying to do that. Is this a sell market? It is not. Is it a buy market? It is not. It's a market that's drifting higher. In Apple, all I keep reading about are the new events. Now you're getting close to September. Here we are, July 16th. You're going to get the release of the new phone. Now the question is the pricing, the shortages of the big new models. I read about it every day and I keep up with it. So we'll see what it does. But it is certainly not something that I'm interested in being short. I think that Apple's one of these trying to shake off the market. Is the trend down? Oh, yes, it is. Until this market takes out this high of 151.74, the trend is down. But the market's also been correcting an oversold condition, coming back up. And I think the 18-week average will be important. Now, does Tesla pick up from here, or does Tesla get hurt because of the Twitter lawsuit? We're going to find out very shortly what this means. Why? The judge that's going to hear the motion by Twitter for a fast trial, that's going to come on track quickly. The fact that it's in Delaware is very important. When you're outside of Delaware, the states can take years. I'm telling you, years before cases get hit. Not in Delaware. There's so many corporations that are registered in Delaware for all kinds of tax reasons and so on. The judges understand cases. They can fast track anything. A long time would be what Twitter wants, 7 months. That's what they're asking for to go through the data. I don't know what the judge is going to say. How do I get in his head? But there's recent cases where the judges say, no, they don't need that much time to get cases going. And that's the argument Twitter is making to see what happens. At the end of the day, I contend this is all about dropping the price of Twitter for Elon Musk to buy it. Not that he doesn't want to buy it. I think he made a bad decision, signed a bad piece of paper when he tried to buy Twitter. I don't know why he did it the way he did, but to heck, he's the richest man in the world. Why do I have to understand what he did? And he did it. So now his lawyers and he will fight the battles. We'll see this, and it's going to be quick. It's either going to be a 7-month or they're going to be in court very quickly. It'll be a quick trial, and he's either going to have to buy it, or along the way as the trial begins, they negotiate a new price. I think that's the end result. They negotiate a new price. Nothing's wrong with Twitter other than price. Still the company he probably wanted to buy. When I come over to Twitter itself, I would think that, you got down, if you take a look, to 32.52. The Bollinger Band low is 32.74. What do I teach? The first challenge of a Bollinger Band, when you're not embedded, the shorts cover everything. That's where I think the short's done. I think that the short play ended on that move. Do I think the market has a lot of downside from there? I want to stick my neck out. No. I think this is still a $40 stock plus, with or without Elon Musk. And with Musk, of course, it's going to go much higher than that, in my opinion. But we'll see what happens. Why would it go higher? Because he's not going to buy it. He may not pay $54, but he's certainly going to pay $48, $50, some number. TLT. Okay. You have all kinds of reasons here to not be short. You lost the embedded reading. Follow me. Any reading over 21, you lose the reading. It happened right here. That often leads to a rally of the 18-week average of closes. And I know the market may not get there. You don't always get there on the weekly chart. The daily charts get there 1, 2, 3. That doesn't mean they hit it every time. Nothing works, my friends, 100% of the time. But the daily is a high probability when you lose an embedded reading to get back to the 18-week or the closest main moving average. The weekly fades away from that, but you generally get a pop to the upside if you lose a bearish embedded reading, which we just did. So that pretty well covers it. That's my news. Let me tell you what I'd like you to do. At this point, take your cursor, follow me, and just go to the top up here anywhere. You'll see an icon appear. We have a lot of free offers. Everything from the pivot point series to the Arun indicators, our newsletters. I think you might want to find that very interesting for the type of trading that we talk about here in the Spiders ETFs. Give it a click. I'm Ira Epstein. Have a great weekend.